In today's video, we will divide into two important concepts in finance, the cost of capital and the time value of money. Understanding this concept is crucial for anyone interested in financial analysis and decision making. So let's get started. So the cost of capital refers to the minimum return rate that a company or investor requires to undertake an investment opportunity. It represents the cost of financing a project or a business. Is composed of various components. So let's take a look at these components. In Indian context, the component of cost of capital include the cost of debt, the cost of equity and the cost of preferential if applicable. Each of these components has a different weight in overall cost of capital calculation. Let's consider an example. Suppose a company wants to undertake a new project that requires a capital investment of rupees 10 lakh. The company plans to finance the project through a mix of debt and equity. The cost of debt is 8% per annum and the cost of equity is 12% per annum. So, to calculate the cost of debt, we multiply the cost of debt by the weight of debt in the capital structure. Let's assume the weight of debt is 40% in this case. So, the cost of debt would be 8% multiply by 40%, which is equal to 3.2%. Similarly, to calculate the cost of equity, we multiply the cost of equity by weight of equity. Let's assume the weight of equity is 60% in this example. So the cost of equity would be 12% multiplied by 60%, which is equal to 7.2%. Finally, to calculate the overall cost of capital, we sum up the weight, cost of debt and equity. In this example, the cost of debt is 3.2% and the cost of equity is 7.2%. So the overall cost of capital would be 3.2% plus 7.2%, which is equal to 10.4%. Now let's move on the concept of the time value of money. This concept recognizes that money today is worth more than the same amount of money in future due to its potential earning capacity. In other words, a rupee received today is more valuable than the rupee received tomorrow. The time value money is used to calculate the future value and the present value of cash flow. The future value represents the value of money at future point in the time, while the present value represents the value of money today. Let's consider an example to illustrate the calculation of future value. Suppose you invest 5,000 in a fixed deposit with an annual interest rate of 8% for 5 years. To calculate future value, you can use the formula, which is future value is equal to present value multiplied by bracket 1 plus interest rate into number of periods. So plugging in the number from our example, the future value would be 5,000 into 1 plus 0.08% into 5, which is equal to 6,805.26. So after 5 years, your investment would grow to the 6,805.26. So now let's move on to the calculation of present value. The present value helps us to determine the current worth of the future cash flow. Let's say you expect to receive 10,000 after 3 years. To calculate the present value, we need to discount the future cash flow using appropriate discount rate. Assuming a discount rate of 10%, we can use the formula present value is equal to future value divided by 1 plus discount rate into number of periods. So after applying this formula to our example, the present value would be 10,000 divided by 1 plus 0.10 into 3, which is equal to rupees 7,513.56. Therefore, the present value of 10,000 received after 3 years is 7,503.56. And there you have it. We have covered the concept of cost of capital, time value of money along with a practical example in an Indian context. Understanding these concepts is essential for financial analysis and decision making in various fields. Make sure to practice and apply these concepts in your studies and research. Good luck with your preparation and stay tuned for the more educational videos.